Let's talk about incorporated businesses versus unincorporated businesses. Unincorporated businesses are businesses such as sole proprietors and partners, and incorporated business is a corporation. Now, corporation is a separate legal entity, while sole proprietor and partnerships are not. So any income from sole proprietor or partnership business is taxed along other personal income of the owner. And with corporations, it's dealt differently. Now, a taxpayer can form a federal or provincial corporation. Now, as a federal corporation, a taxpayer can operate all over Canada in all the provinces. And if it's a provincially incorporated company, it can operate only in that province and has a limited liability in incorporating province. Now let's go over some advantages and disadvantages of the corporation. Now let's go over advantages first. First advantage of incorporating is limited liability, which means if you take any loan or you sign any commercial leases, if it's signed under the corporation name, as long as the owner, which is called shareholder, has not given any personal guarantee, owner's personal assets are protected from creditors. Now, second advantage is income tax. If your corporation is a Canadian-controlled private corporation, then income tax rate, combined federal and provincial rate, is only about 20%. But if you're paying tax on that income personally, you know that we have a progressive tax rates, where the tax, you have to go through different tax brackets. But with Canadian-controlled private corporation, if we have income up to $400,000, as long as it's active business income, you will only pay tax of about 20%. Now, third advantage is tax deferral on bonuses. Let's talk about if a bonus was declared to an owner in this year, then the corporation can take the deduction in the year or in the month that it was declared, but the director or the owner will not have to pay the tax on bonus until the following year. Now, we also have a tax advantage of income splitting. The shares of the corporation can be owned by family members, such as spouse, children, or relatives, and the income can be splitted or distributed to family members through dividends. We also have advantage of capital gains exemption, which is basically if you own shares of Canadian-controlled private corporation and you have a gain, a lifetime exemption of $750,000 is allowed. And again, what if you have a loss? If you have a loss on sale of shares of Canadian-controlled private corporation, or your company has gone bankrupt, then your investment in that company can be claimed as allowable business investment loss. And the last advantage is that this is preferred way of doing business. So if you have a corporation, then normally other creditors and other suppliers would like to deal with you more likely compared to if you were just a sole proprietor or partnership. Now let's go over some disadvantages of incorporating. The major disadvantage is business losses. If you open up a corporation and you're incurring major losses, those losses cannot be deducted against your regular income. It can only be deducted against corporation income. And the second disadvantage is professional fees. Now, to form a sole proprietor or partnership business, it only costs $100 to $200 compared to if you want to incorporate a company, it may cost you anywhere from $750 to $2,000. Plus annual filing of corporate tax returns. If you're filing, the annual fee for filing corporate tax return is way higher than if you were just filing a sole proprietor or partnership business statement.